Which brings us to the cornering of the silver market. Many investors that I work with today still talk about the great time that silver was as high as $50, $60 an ounce, and when gold was $800. And there were a lot of factors that went on at that time to drive the price up. But everyone speaks and talks about the Hunt brothers and how it was their fault for cornering the silver market. Well, let's take a little bit of the blame off of the Hunt brothers' shoulders and explain to you exactly what the confluence of events were at that time, which actually drove the value of silver up so high, and maybe see if silver could happen like that again. At the time, gold was allowed to be auctioned off. In 1979, gold had the first opportunity for the open market to actually set the price of gold. People went out and bought gold, and from the standard rate of $35 an ounce, it was actually driven up to, I guess, a semi-decent amount of $135 per ounce, kind of giving it a breathing room to show that gold did have value. Well, at the time, those people who could not afford to invest in gold decided to buy silver contracts. Well, as they started buying silver and buying up silver contracts, the Hunt brothers came in and figured, well, it'd be a good time to participate in purchasing silver, the actual commodity, as well as purchasing silver, the actual futures contract. So they did this simultaneously. And as the Chicago Board of Trade saw individual and small speculators jumping on the bandwagon, they began to raise the minimums on the margin requirements to keep the small speculators out. Well, it only leaves room for large speculators to see that there's a demand for this. And so large speculators from the United States, and especially from abroad, particularly the Middle East at that time, began to buy up silver and silver contracts. And so the large speculators began to flood the market, again driving the price higher and higher, and creating value for the Hunt brothers. Well, this just couldn't be handled and couldn't be taken by the Chicago Board of Trade anymore. And they couldn't find a way to stop or halt the price in silver because they just knew that it was higher than it was actually worth. But then came the Olympic boycott. And with the Olympic boycott, the Chicago Board of Trade found a strong excuse not to continue allowing people to buy long positions in futures. They used this particular crisis as an opportunity to deflate not only the value of gold, but to also deflate the value of silver. And so they only allowed long positions to be liquidated. And so you see a sharp descent in the value of futures contracts. So gold and silver immediately plunged from 800 to all the way down to 300, and silver shot from a high at the peak of $68 per ounce to a low currently today of $5 per ounce. Huge drop. Now what was unique at this time, and this is similar to the tulip bulb mania, the Hunt brothers were actually borrowing on their physical silver. And so as the price went up, banks kept giving them more loans developed solely against the added value of their silver holdings. So as the silver went from $20 to $30, they'd give them a new loan based on the $30 figure. As it went to $30 to $50, they'd give them another loan, until the point where the Hunt brothers were in debt of over $1 billion. Now, had the Federal Reserve not stepped in and created a loan for the Hunt brothers to cover their debts to the banks, there would have been a huge crisis in the banking system, because nobody knew if silver was ever going to come back. And as history proved itself, so far in 20 years, silver has not. So again, there are a lot of unique circumstances to drive the price of silver and gold up at that time. More recently, we hear of Nicholas Leeson, the gentleman who ruined Barings Bank, an institution that has been around since the 1500s. This group, the Barings Bank, financed the Louisiana Purchase, financed the Spanish-American Wars, financed many of the major events in history, and they were toppled by one gentleman, trading futures. Now, futures are risky, but in this instance, we have an operator who was basically just didn't follow the basics of futures. Now, during that time when Nicholas Leeson was trading futures, there was a huge earthquake in Kobe, Japan. And at that time, he was holding on to over 3,000 futures contracts, believing that the market would go up. The earthquake definitely derailed his idea where the market was going. But instead of getting out of the market, he decided to go ahead and add to his losing positions. So that a month after the earthquake, he had over 19,094 contracts. Needless to say, the CFTC would have defined him as a large speculator. On February 27, 1995, he held Japanese equities, interest rates, futures contracts, and options to a total of $27 billion, all by himself. And the Barings Bank had no idea of what he was doing. And unfortunately, the way his system was designed, he was supposed to be selling option contracts to protect the futures position. Well, it just didn't work out that way, because at the time he sold over 70,892 Nikkei options, but the total value that he received for them was $6.68 billion. So it's easy to see, with $27 billion in arrears, $6.68 billion is not going to cover it. And unfortunately, the Barings Bank had to collapse, because at the time, Barings Bank was only valued at $615 million. You look at this and you can easily see that not only was Nicholas Leeson reckless, Barings Bank was reckless, and this is just a prime example of over-leveraging in the futures market, chasing your losses, and some of the other things we'll talk about in the 10 rules, mistakes that small speculators make. Now, the relevance of futures in your portfolio. Bottom line is Wall Street has gotten more sophisticated. Investors today no longer can survive solely with a buy and hold strategy. Many people have turned to day trading and active trading as a way to mitigate this new Wall Street sophistication. But futures also presents a way to get involved and participate. Wall Street has decided that the average investor needs to just invest in stocks and hope they'll go up, be satisfied with 12% interest rates per year, while they've developed sophisticated tools to take money away from the average investor, either through derivatives trading, futures trading, hedge funds, using option models, following Black-Scholes. They've devised all of these ways in order for them to invest, all the while telling you, just hold on until retirement. This is very unfortunate. And as an investor, you need to take a step back and look at the sophisticated ways that Wall Street is using to take your money and come up with your own to defend yourself and also move with the changing trends. Bottom line is, futures are a great investment to diversify in. They don't correlate with stocks at all. You're able to go short and long very easily, and with the new single stock futures, which we'll talk about in a moment, you have a way to protect and hedge yourself. Concept of modern portfolio theory, which includes diversification, was developed by Harry Markowitz. And in his model, he used managed futures as his example. Managed futures are similar to mutual funds, but they reside in the futures world. So look at how relevant futures can be for your portfolio. Bottom line is, stocks are now a part of the futures universe. You can trade single stock futures just like you can trade any other commodity. You're also allowed leverage now in ways that you could never do before. With stock investing, margin is considered 50% if you're an average person, and you may get a 4-to-1 leverage if you are considered a professional trader, which most people are not. And you have to pay interest on that margin. There's no such thing like that in futures. You put the money up, a small percentage, you're able to participate. You also are able, if you have a huge investment portfolio, to use futures to hedge yourself and protect yourself from huge fluctuations in value, whether the market is going up or down. You can also use this opportunity to shorten futures without guilt or worry about different regulations. So futures is very relevant for today's portfolio investor.